Thanks for clicking. The Toronto Regional Real Estate Board released its sales data for the month of January this morning, showing continual drops in prices and sales, but also showing some tentative signs of stabilization, and I stress tentative. The board said that with the Bank of Canada pausing on interest rate hikes, population growth and tight labour market conditions will support housing demand moving forward. Yet the board appears to be ignoring the cumulative effects that the Bank of Canada's interest rate hikes are having on homeowners and on the real estate market.
Why would I start now?
Indeed, the board's release comes amid a growing number of stories of Toronto properties selling at a loss, with the GTA reporting a five-fold increase in the number of properties selling for less money than that which was paid for them. And the data also comes amid the release of a new poll, showing that 45% of holders of variable rate mortgages will have to sell their properties within the next 9 months if the Bank of Canada doesn't reverse course on interest rates. So what I want to do today is go over Toronto's real estate data for the month of January, take a look at some of the stories coming out of the GTA with homes selling for less than that which was paid, take a look at this poll, and then discuss what to look for next. Speaking of next, the Bank of Canada Governor Tiff Macklem is set to speak next week, which will be his first speech following the Federal Reserve's announcement that they will be continuing their path of interest rate hikes while the Bank of Canada pauses. Whether or not the governor will address the reasons for this divergence remains to be seen, but we'll obviously have an update out on that speech on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this data. Under the data, first off, the benchmark price. The benchmark price is the price of a home which represents the most popular set of features. In December, Toronto's benchmark price came in at $1,081,400, and that dropped down about $2,500 in January, down to $1,078,900. The average price of a home in Toronto, however, fell much more substantially. The average price in December was $1,051,000, and that fell down to $1,038,668 in January, about a $13,000 drop just in January, but over a $200,000 drop since this point in time last year. And while the benchmark price and the average price were down in January, the median price actually bumped up a little bit. The median price, that's where half as many homes are sold over that price and half as many homes are sold under that price. The median price in December was $888,000, and that bumped up to $900,000 in January. So we have about a $12,000 increase in the median price.
Don't lose this opportunity.
With that said, inventory also bumped up a little bit in January. If we look at the months of inventory measurement, that's if no more homes came to market. How long would Toronto last before it ran out of homes for sale? The months of inventory measurement, the MOI, in December was 1.9, and that bumped up to 2.0 in January. So we have about 0.1 months more of inventory available on the market. And then the sales to list price ratio, which measures by how much over or under the list price a home sells, that was sitting at 98% in December and remained at 98% in January. All in all, we continue to see a slowdown in prices, but that slowdown is somewhat easing for now. The benchmark price down about $2,500, the average price down about $13,000, the median price up $12,000. We have a little bit more inventory, and the sales to list price ratio has remained the same. With that said, it's growing increasingly possible that the GTA could see even more downward pressure on its prices over the next few months, as there's mounting evidence of anticipatory selling, with more and more properties selling for a loss.
The king ordered it!
Indeed, Michael Carney of House Sigma noted of one property in Brampton which sold for $340,000 less than that for which it was purchased nearly a year ago. In another case, in Etobicoke, a condo was sold for $60,000 less than it was purchased for midway through the pandemic. And it's not just these two properties. Between October and December of 2021, the GTA saw 51 properties sell at a loss. But during the same period in 2022, just a few months ago, that number was up to 224. So in 2021, 51 properties sold at a loss. 2022, just a few months ago, over 220 properties sold at a loss. And although Carney said that it's difficult to speculate as to why these homeowners are selling at a loss,
mystery.
It's difficult to imagine a situation where a homeowner, where a property owner would willingly sell for a $60,000, $100,000, $340,000 loss. In general, homeowners don't sell at losses unless they're forced to. And this is being borne out in the recent poll that was just released. According to a new poll from Yahoo, 35% of homeowners that have a mortgage don't think they will be able to hold on to their properties beyond the next 10 months, with 45% of holders of variable rate mortgages specifically unable to hold on to their properties for the next 8.3 months. And yeah, it makes sense. If you had a decent prime rate locked in December of 2021 at prime minus 0.75, and you bought that average priced home at $1,242,407 in January of 2022, you had a mortgage payment of $3,616. Fast forward 1 year and rates are up by 4.25%. That payment has now bumped up to $6,036. That's $2,400 more in mortgage payments in just a little over a year. Savings, lines of credit, help from family, these Band-Aid solutions can only last so long while these homeowners try to wait out the Bank of Canada. Wait for the Bank of Canada to reverse course and for these mortgage payments to come down. And the timing isn't great for those 45% of holders of these variable rate mortgages. For the Bank of Canada to reverse course, inflation would have to come down to say 2 or 3% in the next 8 months. That gives us until about September for inflation to come down, and this comes at a time when China is coming back online, which is expected to lead to higher oil prices. We have higher wage demands, and many are predicting that inflation could remain sticky. So if inflation doesn't come back down to that 2 or 3% by, say, July or August, and the Bank of Canada can reverse, which is growing increasingly unlikely as the Federal Reserve continues to raise rates. If that doesn't happen by July or August, we could see a flood of new properties coming to market. Not because the banks are taking those properties. This isn't going to show up in the default rate that is so often cited. I'm talking about anticipatory selling. These holders of variable rate mortgages getting out while they can, before the value of their homes drop and before this starts to hit their credit when they're unable to make their payments. There seems to be a real idea out there, and we've talked about that on this channel before, that the Bank of Canada stops raising rates and then everything's fine, that the real estate market goes back to normal and we're off to the races. But we still haven't had that recession. We still haven't seen these variable rate mortgages bite. We haven't seen these payments come to a point where owners are selling their homes in anticipation of not being able to make those payments. There's so much focus on the default rate, which is still at a record low, even though some are predicting that that's going to shoot back up. There's so much focus on this default rate, but the anticipatory selling is and probably will, according to this poll, lead to more homes coming onto the market, which will put even more downward pressure on Toronto's real estate prices, on real estate prices Canada-wide. So, in summary, prices coming down a little bit, the benchmark price down $2,500, the average price down about $13,000, the median price up about $12,000. More inventory is coming onto the market, but that's not leading to major price decreases just yet. There are some signs of stress growing in the system, some cracks, homes for selling for less than that which was paid, and more variable rate holders reporting problems with their payments, not being able to make those payments now that the Bank of Canada has raised rates by 4.25 points. With that said, how high interest rates go, whether or not the Bank of Canada can reverse course, will all be dependent on Canada's inflation rate, which is set to be released in a couple of weeks. We'll obviously have updates out on that inflation rate on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.